Get to the exciting part of the discussion about markets and what kind of returns are your portfolios likely to generate over the next 1 year. By the way, before I start with the discussion with the esteemed panel, uh, I would like to just tell you some data points. Between last Global Investor Conference at Mehta FinCon and this one, Indian markets have on benchmark rallied some 25%. Broader markets much higher. So how many investors here are expecting similar kind of returns from markets in 2018 as well? 20-25%. Raise your hands. Okay. 10 to 15%? 5% people. How about 5 to 10%? Nobody. How about negative returns? So that's where you're standing right now. Bulk of the people, 20% believe similar returns, 2-3% believe 10 to 15, none believes 5 to 10, and none at all negative returns. So that is the first question we'll start discussing with Ravi and KK. What is the investment landscape looking right now with that kind of handsome returns under the belt already for the year gone by? Ravi, let's start with you.
Thank you very much. And I think it's very pertinent to understand that we've had a phenomenal run in the last 3 years, and a lot of it is actually in terms of the hopes. And we just had a wonderful panel discussion just before this in terms of how the economy is going and where the mutual fund industry is actually going. The last 3 years have been more of structural changes. And equity markets as such, are slaves to earnings. And the biggest thing to look forward to is the earnings growth. Now, the markets have actually reflected a lot of the positives in terms of the earnings growth. I mean, we're already discounting FY19 and to some extent FY20 as well. So it is very important that some of these structural stories actually pan out and translate actually into earnings. So it's good to have a moderate kind of an expectation. I think even last year, if you had asked this question, I don't think anyone would have got it right. So
I'm happy that we are starting our discussion on a balancing note and a cautious note, because people are already geared for a lot of excitement this year as well.
Yeah, I think the important thing is, as the last panelist actually reiterated, that you have to be long term in this business, and it's okay to be fashionable, with short term stories and the success stories. But I have seen 3 bear markets, my life, and it's always good to be long term, because then you smoothen out the volatility. So coming back to your question, I think moderate return is something which is good to expect, because the earnings momentum has to catch up. So effectively, I think if you ask me about the next 3 to 5 years, I think I'll be much more confident in answering rather than the next 1 year.
Right. KK, for last 4 years, every year I ask you the same question: how will the earnings pan out this year? We start off with 15-18% expectation, start moderating. But this year, the financial year 18, we have seen relatively better first 2 quarters. How confident are you that the earnings recovery, after eluding us for 4 years, is genuinely on the mend, and it will come not just because of the low base, but actually turn around on ground?
I think Ravi mentioned, the last 3 years, the government has tried a lot to do structural reforms in this country. A lot of things have changed. We've gone through issues like demonetization, which did have a disruption, but a positive one. We have gone through this execution of the GST, implementation, which has been disrupting growth for a couple of quarters, and still is going through various modifications and relaxations. So with all this and the efforts towards ease of doing business, etc., the government has set the platform right for strong decadal growth going forward. At this point in time, if you look more at the macros, again, India seems to be in a strong footing. If you pan down towards the micro setup, the September quarter itself showed a lot of improvement in terms of growth across various sectors. Forget the banking, the corporate banks and the banking sector for a time being. They are going through the pain of recognizing the bad loans and providing for them, etc., which have pulled down overall the earnings growth of the broad benchmark, etc., where financials contribute about 35% of the weight. If you exclude the financials and look at the overall economy and other sectors, we have had very good growth recovery that's been happening. And over the last 4 quarters also, we did see a steady improvement in terms of earnings growth, ex of financials. Into the next couple of quarters, the quarter that ended in December and the fourth quarter, we expect them to show very strong growth recovery and a double-digit earnings growth, which we believe will be the inflection point for the markets in terms of recognizing earnings coming through. FY19 again is going to be a year where there will be quite a broad-based earnings recovery in the Indian economy, and the financial sector also will contribute because most of the pain is behind us in terms of stress recognition and providing for the stress, etc. With the NCLT and other provisions that are available, we see in the next 6 months things to be fairly better even from the financials and the banking sector front. The PSU bank recap that is ongoing is definitely going to be like blood flowing through the body from an anecdotal perspective. We see that the credit flow into the Indian economy will accelerate in the next 12 months. And overall, we expect earnings growth to be in high teens into the next couple of years. And we believe that will be, again, turning into the market returns. Like Ravi said, while valuations probably factor in a lot of the positive expectations, the PE re-rating may not be something that we should look forward to, whereas the market returns can be driven by earnings growth that will come through. That's our expectation on to the next couple of years.
In fact, to give them their accolades, that the credit growth has come back to 9-10%, if not higher. Keyur, you also seen, at Mehta FinCon, you guys are helping people invest for multiple decades now. What is your sense of the cycle, the business cycle, the economic cycle we are in right now?
Yeah, so actually it takes around 3 to 4 years after the crisis to set things right. And in the initial phase, when you focus on improving the macros, you definitely take a hit on corporate earnings. And this is what has happened in India. In last 2-3 years, what I see is the Nifty earnings are flat to 2-3% compounding. So talking about the turnaround stories, right? So 1991, we had a crisis. And after that, Manmohan Singh and Narasimha Rao took the right steps to turn around the economy. So if you track the quarterly earnings from 91 to 94, the earnings were flat. And then in September 94 is when the earnings spiked. So the market started sensing it 1 year back. So market started rallying from September 93 and 1 full year ahead. So markets always tend to discount the future and front load the lot of expected earnings. Similarly on the downside, right? So in 2008, if you would have asked any corporate, mid 2008 I am talking of, they would have said, my earnings are doing fine. The problem is in US. But the market started sensing and started collapsing. So PE collapsed first and then the earnings fell. So in a turnaround, what happens is earnings is always a lagging indicator. So PE goes up and then the earnings follow.
Right. Ravi, let's talk about 3 different aspects of market. One is there's a cyclical recovery at play. However gradual, that's questionable, but there is a cycle which is at play. There is a global growth which tailwind as well. First time in many years, the global growth is likely to be higher than estimates. And then there is a set of initiatives via reforms and other things which the government is taking to kickstart the economy. And as a market participant, you have an eye on all the three of them. How are these three key points playing a role to drive market and stock prices, and how much of that is in the price in your view?
So you're absolutely right, because all the three factors are at play right now. Predominantly in certain sectors that Krishna Kumar just mentioned, that there have been pockets which have been disappointing, and these are like almost 25% of the Nifty. Particularly the infra side, the metal side, the PSU banks, etc., where the earnings momentum has been missing. But quite frankly, I think the efforts that have been taken, so the first 3 years went in obviously restructuring the entire, what should I say, the entire economy, the structural, put the base in place so that, the building blocks can be put together. I think the investment phase is going to start. Over the next 3 to 4 years, I think the focus is going to be largely in terms of the capex recovery cycle. A lower interest rate scenario obviously would help, because that's one of the big triggers to start a capex cycle recovery. In terms of the global economy, again, and not to forget the rural side as well. I think the rural infrastructure, rural consumption, I think that's going to be a very big theme as we move forward. In terms of the global recovery, obviously, that will help because, large part of our economy is export oriented, especially IT and pharma. So, in case there is some bit of global recovery, and mind you, IT, last year, for example, 2017, the IT sector growth was just about 10 or 11%. It's still reasonably good, but, gone are those days when they used to grow by, 18, 20%. So, if there is a global cyclical recovery, I think that will help a lot of sectors in India, especially in the engineering side, chemical exports, etc., etc. And finally, sorry, what was the third point? Yeah, so the government initiatives have been very, very consistent, and I think that's going to, come back to focus, because even the finance minister has already said that this budget, they're going to actually focus on the economic recovery. Because the last 3 years, quite honestly, has been spent in cleaning up the system, in various different formats. Whether it is the direct benefit transfer, the Aadhars, the opening of the bank account, demonetization, GST, the power sector reforms, getting the SEBs in order, and most importantly, the banking system as a whole. There's been a phenomenal amount of work. That's not been visible, unfortunately. It's not been translating into the earnings. But, as we move on, once the focus goes back into growth, I think it'll be a double whammy effect in terms of the earnings numbers.
In the light of the environment we are in, how are you looking at various sectors which are looking promising? When I say promising, what I mean to ask is valuation versus, mean reversion will happen because of, say, IT pharma, you think? Or where promising that earnings will be led by certain sectors? If you could talk of some of the key sectors, the dynamics at play.
Yeah. As an investor, if I look at, the markets the way they are, I would think that in the last, 3 to 4 years, we have seen a lot of normalization of valuation multiples across sectors, predominantly mid caps and small caps. You look at them, they're normalized, right? And if you look at also the kind of stocks which have done well, sectors done well, we've seen a fair amount of money chasing high quality, high growth stocks with good balance sheets, good promoters, etc. So growth at any price kind of valuation framework is what worked. Over the last 6 months, we have seen that there's been a kind of pullback around that, and people are getting a lot more valuation conscious, value conscious, and I think a framework like growth at a reasonable price is something that is kind of falling into place at this point in time. the reason, I'm not talking about sectors, but about evaluation methodology framework that will probably be working, is the reason is that across sectors, I see in the economy, there is a fairly robust growth that we see. If you take, automobiles, take two-wheelers, cars, there's a fair amount of growth that's happening. If you look at the rural sector, transport, tractors again have seen good growth. Look at trucks, I think very good robust growth that we are seeing at this point in time. Take consumer discretionary, look at brand companies, look at retail, look at consumer durables, white goods, kitchen appliances, lifestyle products have good growth. Similarly, coming back to the core sectors, infra has seen a lot of pile-up of order book, and the growth is kind of getting more strong at this point in time. And with that getting better, demand on steel, cement, and other trucks and other sectors also getting better. So the growth, is quite all-round. Like you mentioned, the global growth coming back is also helping sectors which are supplying to the global markets. So with this kind of a robust all-round growth that we are seeing, I would like to probably rather talk about what kind of stocks will do well, because stocks will be doing well across different sectors. So stock picking through a GARP framework will be something that would be quite something that the investors should look forward to.
I'm sure a lot of people over here would like to know what stocks will do well, but you cannot talk about them clearly. What are your thoughts? Which sectors look attractive to you?
So-
On an argument, growth valuation argument, because everything has run up right now. Potential of growth on valuation terms.
Right. So actually, there are a few pockets in the financial services sector, the likes of asset management companies, wealth management companies, and insurance companies. So the very fact is that these companies are getting listed now when we have come so far. So we have crossed the market cap of $2 trillion, and we did not have a single asset management company or insurance company listed at all. So usually it's a big part of financial services domain. And the earlier panel discussion discussed about the structural change which is happening from physical assets to financial assets, right? So whenever such structural changes has happened in past, it has lasted for years and decades. And to give you an example, telecommunication would be the best example. So there was a structural shift from landline to mobile. So it started 15-20 years back. But in 2002, the number of mobile subscribers in India we had was 1 crore. Today we are at 121 crore. In just 15 years, you can see the jump from 1 crore to 121 crore. So see the kind of opportunities we have, right? So same kind of opportunity we can see from this structural change, and the beneficiaries would be wealth management companies and asset management companies. Another thing Krunal said in his welcome note that last 50 years the problem was how to earn money. Now next 50 years the challenge would be how to manage money, right? So we have, just to share with you our data, 0.7% of world's population manage or have 46% of the total wealth. And I can see 500 people sitting here out of that 0.7%. So who is going to manage your wealth? Definitely it's the wealth managers, and definitely we would be passing on to the asset management companies. So these two sectors I feel good. Talking about the insurance sector, the insurance penetration in India is at 3.4%, way below global average of 6.8%. And 1% increase in insurance penetration translates into 13% reduction in uninsured losses. So in simple terms, it reduces taxpayers' contribution by 22%. So this is why insurance is very important. Talking about insurance growth, we expect it to grow at 14-15%. And there are a few companies in insurance sector itself which can outgrow this sector by 3, 4, 5% compounding. So say the likes of HDFC Life, SBI Life, ICICI and Max. So these are the four big companies, and they almost enjoy a 70% market share of these private players and 75% of the total profits of the private players. So valuations, as you told, that it can be argued that they are full as of now in these sectors, but holding these stocks for next 5 years, 10 years can create immense wealth for investors.
Sure. And some of them are being called as compounding stories rather than alpha. In fact, let's take that point ahead. Ravi, we did see 2017 new representation come to the market. Insurance companies, all kinds, life, general, start coming in. Asset management companies, one of them got listed. Many are lined up right ahead. How do you analyze the business models of this space? Because the incremental allocation to financial services is moving towards these plays. I'm sure you must have also played it in your own portfolio. What are your thoughts here?
Yeah, so clearly, as has been stated, that the scope of business is something that we look at. So when we analyze businesses, we generally look at it from A, either is market share, B, value migration, and 3, balance sheet restructuring. So we sort of scan the entire universe and say, are there any opportunities in any of these? I think the insurance and asset management companies belong to the first. What's the scope of the business? How big can it get? It can grow immensely, in my point of view, because as we know, Indians are underinvested. There is very little advisory services going on. We're just barely scratching the surface, in any of this. And there's deep underpenetration. So as the population matures, as we see incomes going up, apart from the roti kapada makan that usually Indians are familiar with, I think the discretionary spending, I would call this, just like the mobile revolution, as he spoke about, I think even within financial services, there's going to be a massive transformation that's going to.
Now it's becoming roti, kapda, makan and SIP.
So I think we as Indians are actually moving in that direction, and at every level you'll find that transformation. So, because of this, just the sheer scope of the business, valuations apart, I think, and under penetration, there is a reasonable amount of growth that we see in the next 5 to 10 years.
KK, do you think the incremental money is flowing to these areas discussed, asset management companies and insurance, at the cost of also another area of financials? Perhaps private sector banks, higher competition ahead, corporate banks, no incremental lending over here, or PSUs starting to look more attractive and NBFCs less. Do you think that is also a case?
See, I think, if you look at markets and, how sectors evolve, you will definitely find that, with new services and product offerings coming through, there is definitely equity participation that investors like to have based on the scalability of the business, basically, and also, the kind of promoters and entrepreneurs backing those businesses, right? So I think clearly in the financial services space, given the case of India being where it is in terms of per capita incomes, which are rising above $2,000 at this point in time, and the kind of underinvestment in equities and insurance, etc., there is a clear scalability perspective that this industry offers. Hence, this would definitely be a very significant part of the financials portfolio of any mutual fund or scheme or a PMS that one would launch. So I think, like you mentioned, I think these are all compounding stories given the kind of growth that's possible over the next 10 to 20 years. Like today morning, we're discussing with somebody in Surat, just to discuss what would you buy for the next 30 years. We're just telling him that, you should pick a life insurance play, you should pick a general insurance play, you should pick a mutual fund to invest, a wealth management boutique company, and a retailer that would take you to the next 30 years.
I think this is the closest a fund manager can get to a stock on a public platform.
Yeah.
If you got your message.
So I think it's just like that, right? So you just need, these are sectors which are like looking like the levers of 1980, the ITCs of 1975, 80s, right? So these are nascent high growth sectors, and definitely they would be quite attractive to be a part of.
Sure. Ravi, let's talk about looking at particular sectors from government initiative point of view. You know, like 1.5, 2 years back, the entire oil marketing company pack got re-rated because government said, deregulation and DBT, all of that happened. So re-rating of sector happened. Then now Bharat Mala has been announced, and irrigation is being, agri area is being spoken about. What are your thoughts on some of these government initiative-led sectors which have started to look attractive?
I think it's a very interesting question because, like I said, the need of the hour is to revive the capex cycle in India, because we've been talking about this since a very long time, and unfortunately, all these sectors that you mentioned, have actually gone on the sidelines, primarily because we were grappling with so many other issues. And the last 4-5 years, not much of momentum has been created around this. But it's about time now that, most of the groundwork has been done. The focus is back on growth, employment generation. I think, this is one of the biggest themes, in 2014 when this new government came in. I think employment generation was something that was spoken about. And I think what better industry could be than infrastructure. But having said this, I think if one were to look at investing in infrastructure, I think one has to look at it from a very long-term perspective. Because this is not a consumer-oriented company which grows at a steady secular kind of growth rate. The growth rate might go up and down by maybe 2-3 percentage points here or there. This is a very cyclical kind of an industry, and I think if one were to specifically invest in these kind of segments, one has to have a much longer term kind of perspective, because just purely banking on government initiatives, can become an issue, because the timings could be very different. The timing of the investor versus because a lot of these capex oriented things, they take 2, 3, 4, 5 years to even pan out.
Infra, just to interrupt over here, in the last couple of years, infra as a space has more been a balance sheet repair play, and then the visibility of, so that balance sheet repair happened and the stocks. Now you think the next leg can come where visibility of earnings and orders, and hence
so in pockets, things have actually happened. Like if there's one area where a lot of work has happened, that's roads, right? And I spoke about the power sector reforms as well. The restructuring of the SEBs, etc. So in pockets you'll find a lot of opportunities, if I may see. And GST, perhaps one of the other legislations, like logistic companies, 70% of this business is all unorganized, right? So once GST and e-way bill and all those things fall in place, I think there's going to be a huge momentum, shift from the unorganized to the organized segment. So one has to be very, very watchful. I mean, as infrastructure is a very large space, so you can't generalize and say, certain things will do, the entire space is going to do well. Because each of these components will have a very different gestation period. Some will pan out in maybe 12 months, some might take 2 years, some might take 3 years.
Right. KK, I'd like your opinion on global sectors. 2017 was a disastrous year for pharma, for IT, valuations got compressed. But similarly, another global sector which phenomenally well was metals, again a global. 2018, what's the outlook on these three global sectors? Do you think mean reversion can happen? Do you think further value creation can happen?
I think, sectors like IT, there is a lot of technology disruption that has been happening over the last many years. And, you hear a lot about artificial intelligence, machine learning, deep learning, and what you may talk about. I'm not even just talking about cloud or digital, etc., right? Things are going beyond. So IT is replacing humans in different walks of life. Internet of Things is also one. So what is happening is, the kind of job opportunities or the kind of IT spend done by companies is now changing, and that is basically clearly contracting the kind of market opportunity in many areas, which are big drivers earlier, like infrastructure management services and offshoring and application development, etc. So a lot of things have changed, and the ground is moving beneath our foot. So IT, I think, is going to be a sector which will find growth hard to come by. Probably mid single digit kind of growth. With pressure on profitability to continue. It would be an excellent industry from a cash flow perspective, so there'll be a lot of value, and you would see companies probably resorting to a lot of buybacks, etc., and return of capital, return of shareholder funds. So that could keep interest alive in the sector from a cash flow perspective and valuations. I think that would be that at best, and you'll be having niche plays here and there. On pharmaceuticals, again, our belief is that the Indian pharma sector had a lot of things going in the US generics market in a significant manner. Now we are over the generics cliff, and the kind of opportunities that are available are not as big as they were earlier. Plus, the Indian industry had to face the music from the US FDA authorities in terms of compliance of procedures and also facilities. So we have lost a lot of ground there, and the market is consolidating there on the pharmacy space and the hospital space there. So clearly, the growth is under pressure, the profitability under pressure, and we would be very choosy in terms of exposures in pharmaceutical sector, which are typically, companies which are having more complicated stuff they're doing, and which probably are more into biotech and stuff like that, and probably a lot more focused on local markets. In terms of the last part on commodities, basically, the global commodities, our view on oil clearly is that oil has seen some seasonal uptick because of the very cold winter in the US. Over the next 40 days, we do expect crude to come back to $60. So medium term, I think crude is going to be quite reasonable, balanced at about $60 pricing, and hence that would be the kind of base case. On the metals front, again, over the last many years, we've seen a lot of action taken by Chinese government has also been helping, in addition to the consolidation that's happened across in the various developed markets, etc., and supply being kind of well controlled. We have seen a good demand improvement in the last many years. Slowly things have got better, and we reached an equilibrium, and that's been the reason for metals to do well, basically. But at this point in time, I think, like in crude, I think it's a lot more discipline on the supply side that's helping, and we do see that the supply would kind of come in to take care of the incremental demand. So we are not very much of the belief that it's going to be a super bull market in commodities. I think it's going to be a market where supply would catch up, and we would have a moderate inflation of about 5% going forward. So I think it will be more volume-led improvement further from these levels on.
So metals is a avoid.
I wouldn't say an avoid. I would say that the kind of repricing, reflation that you saw till now, I think that's done. Now it's a lot more driven by input costs, etc. It would be a fairly constant spread business and more volume driven from a growth perspective. There will of course be opportunities to play there.
Sure. Keyur, what is your take on, or when you deal with clients over here, mostly HNI, ultra HNI, last 2 years clearly belong to mid and small, and the chances, what are the chances that rally will continue versus large cap, which have done well but have lagged their broader market peers? Your thoughts?
So talking about the large cap, actually many people believe that there is no money to be made in large cap, but as Kunal said, that a large cap company, Maruti, which is 3 lakh crore market cap, has multiplied by 7 times in last 4 years, right? So it has outperformed more than few mid caps and small cap companies. As we see, the valuations are stretched in mid and small caps, but large caps looks more attractive than what mid caps offer or mid caps and small caps can offer at this point of time in terms of safety.
Right. Okay, so let's go back to that main argument. This rally actually started in Indian equity 2013 onwards. We are sitting in 2018 January now. What phase of the bull cycle are we in? Ravi, what's your call?
I think we are somewhere in the middle of the cycle because, like I said, you know, the economy hasn't done, the markets have done, markets have reflected a fair bit of expectation and hope in terms of the economic revival. Just like the bear cycle, you know, takes a very long time, even the bull cycle, you know, the expansion of the economy is also not going to stop abruptly. It's going to be a fairly long cycle, and if the policies and the consistency of those policies get played out over a period of time, I think that will be reflected in the earnings numbers. And, you know, as a result of that, I think we are somewhere in the middle. And, you know, this valuation argument keeps coming back all the time because, you know, everyone feels, and, you know, when they look at the index and the absolute number, it appears to be very, very scary. And most investors, you know, take hindsight, you know, numbers and say, oh, you know, the market's trading at 25 times or 30 times. But quite frankly, you know, like I mentioned, you know, 25-30% of the sectors have just not contributed to the numbers. So if you really adjust that and then, you know, put the future forecasted numbers, I think the valuations are pretty reasonable right now. Yes, the number of opportunities that are there are definitely coming down. It's not going to be easy from here on. You know, quality needs to be maintained in terms of portfolios, etc. You know, in terms of stock selection, etc. So, you know, it is going to be challenging, but I think once growth picks up, you know, valuations will moderate and then.
So, supply of fresh paper from the government side is also quite high. They are the big sellers in this bull run. KK, what is your view? What stage of the bull market are we right now? The early stage is gone. Mid cycle is expected to be quite prolonged. Do you buy that argument?
See, you know, rather than looking at the bull market cycle, if you just step back a little and look at the economy per se, you know, we've are not, you know, really seen stiff growth that's come through, right? We are still ambling at about 6% kind of growth and looking to go to that 7% growth into the next 12 months, right? So, and it's been like, you know, fairly long time we've ambled along. So I think we are very close to the middle of the cycle, like as Ravi mentioned, and from a market perspective, it trades a little ahead. So probably we are just around the middle point there or a little ahead there. But, you know, I think what we need to keep in mind, you know, as you talked about valuations also here, is that, you know, if the confidence of the investing public is quite high, then people tend to look forward into N and N plus 1 year also. Sure. So while one may say that we are already discounting an FY19 earnings and markets are probably at about 18 times of FY19 in terms of Nifty valuations, but just roll it over into FY20 basically, one more year of growth. And I don't think anybody here has two opinions that you know, the growth is going to be better going forward, right? With all the banking sector problems solved and the earnings coming back on the banking side, etc., with growth at about 7% on the GDP. I think we are looking at, again, you know, earnings doing well and markets are trading at about 16 times FY20, right? So I think, you know, typically in expansionary phases in the economy and in bull markets, people are more confident about the long-term outlook and are willing to pay a little more higher price and look forward into the markets basically. And that's where we are. So I am, for one, not really worried about the markets or the valuations right here. I think, you know, the base is set, the macros have been, you know, really kind of have done well, and, you know, it's time for good growth into the next couple of years. So that's where I would see. And if you talk about the public, if you talk about issuances from the government, etc., I think they are very much necessary, right? You just mentioned that we're getting about 25,000 crores from the investing public every month, plus the insurance money that comes in, the PF money, etc. And that's
it's a neutralizing agent of
that's about
sorts.
3 lakh crores, right?
Yeah.
So if you don't have IPOs, if you don't have PSU divestments, etc., then where do we put the money,
So
right?
you think bubble like
Yeah. So you need a sink, right, to
Yeah.
also observe. And if you get good quality papers of companies, I think that's a nice situation to be in.
Okay. Keyur, what are your thoughts? The clients you deal with over here, both on the mutual fund and the PMS side, out of the discussion we had so far, what is your view? What kind of CGR returns on a 3-year basis are still possible from this market, looking into already the run-up which has happened?
So actually, let me first explain the difference between a mutual fund and a PMS, right? So we get a lot of queries about difference between equity mutual funds and equity PMS. So first is, let me share with you all an interesting data that out of the total market cap of 150 lakh crore, we have around 20 lakh crore rupees in a way where investors are holding direct shares into their demat account. A lot of them are taking advice from their broking partners and executing trades on their own, but a large part of it, a large part of demat holding I am saying, is dormant. And when we meet such investors, what we do is we take the portfolio, we ask them since when they are holding, and we compare that stocks, that particular portfolio, along with the dividends and bonuses with our PMS and mutual funds. So what we have found out is, in most of the portfolios are not, the returns are not even beating the FDs. Forget benchmark. So my advice for that investors would be, if you want shares in your demat account, it's okay. PMS has the same facilities that you can hold shares in your demat account, but let the professionals manage it. So they will at least beat the market. There are few differences between mutual funds and PMS. See, both are managed by professionals, so both are good. I'm not saying one is good or one is bad, but there are some advantages and disadvantages of one over other. Talking about the mutual fund, actually it is a pool of vehicle, and depending on the past returns, there are inflows, and depending on the past bad returns, there are outflows, right? So a mutual fund portfolio on a day-to-day basis gets diluted or concentrated. Whereas in a PMS, what happens is, it is your individual demat account in which the shares are credited. So say for instance, you subscribe for a PMS today, your shares will be bought and credited to your demat account. After that, as many as investors come in and go out, it will have no impact on the stocks which you have bought at your buying price. So this is one difference. Second thing is, because a mutual fund is a diversified portfolio of 50 to 60 stocks, and PMS is a 15 to 20 high conviction idea portfolio. So definitely a PMS over a long period can outperform marginally over mutual fund. There is, because there are retail investors in mutual fund, there is some cappings on the stocks and everything, so by the regulators. So in a mutual fund, a fund manager cannot go beyond 10% of the overall allocation in a particular stock. So once it starts crossing 9.5%, the fund manager has to start trimming it, right? So in short, they have to sell their winning stocks. And this can lead at some times to a marginal loss, we can say reduction in the returns. Whereas in a PMS, what happens is there is no such capping. But generally, after crossing 15%, they start trimming it and they don't go beyond 20%. So this is second difference. Third difference is, because mutual fund is a diversified portfolio, there is a sector allocation which has been made in every sector, almost every sector, good sectors. Whereas in PMS, if the fund manager does not like few sectors, like the likes of pharma, Mr. Krishna Kumar discussed, in last 2 years, the pharma index itself is down by 20%, right? So in our recommended PMS, none of our recommended PMS, we hold PMS, pharma since last 2 years, 3 years. So this reflects to marginal alpha. One advantage mutual fund has over PMS is the taxation part. So mutual fund you buy today and you exit on 366th day, your returns, your gains are tax free. Whereas in a PMS, if there are some profits booked before 1 year, you are liable to pay a short-term capital gain of 15%. And if there are any after 1 year, it would be tax free. Having said that, let me share with you that at Meta FinCon, whatever PMSs we recommend are having a average holding period of 3 to 4 years. So there are very less chances of short-term capital gain.
Right. Actually, on that note, since we are coming to the fag end of the discussion, let's have some quick questions for our fund managers from the audience. Guys, any market-specific, sector-specific questions? Raise your hands. Okay, the gentleman in the middle, please. Can you pass the mic there? 1 second, sir. Let the mic come to you so that everybody else can also listen to your question. बोलिए सर, आपका क्या सवाल है? ओके, आईटी सेक्टर पे आउटलुक पूछ रहे हैं आप दोनों का क्विक. We cannot hear you. I think your mic is not working. But he wants to understand the outlook on IT sector.
Hello.
Yeah, clear. बोलिए sir.
As a part of H1 visa policy,
H1B visa issue
so
हो रहा है,
many
तो
IT professionals are likely to come back to India. So what is the outlook for that IT sector?
See, in terms of broader issues, we did discuss and answered Ajay on the last question. On a longer term, there could be some improvement that can happen, but near term, as we discussed, there is a lot of technology disruptions that have happened, and where the human intervention is being replaced by IT, etc., and by machines. So that's going to kind of restrict the growth in IT spend basically at this point in time. Plus, as you also mentioned, there are several other issues in terms of staffing, given the new regulations that the US government is trying to bring in. This is not something new, but Indian companies have learned to live with changes. Indian companies have learned to live with changes in the US visa regulations, etc., moderating a little bit between onshoring, offshoring, local hiring of people, etc. So while this particular issue that you talked about will be handled effectively by the IT companies and not be disruptive, but overall I think the growth of the industry itself is broadly in question, which is why I did mention that it is more value-oriented sector with good free cash flows, which can be used to return cash to the shareholders and can benefit from huge dividends, etc. So that's the way to play IT, not as a growth stock, but as a value play at this point in time. I would probably pass on to Ravi.
Yeah, nothing much to add. Apart from the fact that although the sector headwinds are indeed very strong, but given the recoveries that we are seeing over the globe, there are chances that there will be some improvement, but I think the other challenges like the visa and some of those other things will increase the costs of doing business for Indian IT companies. So we've already seen the price earnings multiple derate over a period of time. The earnings perhaps have bottomed out. So we are in a value zone, but we can be in a value zone for a fairly long period of time.
Sure. Last question. We are almost running out of time. Can we have a question? Okay, two questions here back to back. Make it quick, guys. Over here, can we have the mic here?
Excuse me, sir.
Okay.
Sir, just further to his question, I also want to just want to know about the challenges like within if we talk automobile sector, which is as per him as he discussed about Maruti stock. Also, we need to concern on the factors like pollution, which we should concern, like how we can see further growth of automobile sector concerning all these factors. Like we all know about the Delhi, the levels are very high. Similarly, the global, if we talk about global market, like the effect of North Korea in our, so overall, how our Indian market is sensitive to all these factors?
Actually, there are two questions hidden into one. Outlook on auto and
Yeah, so I think, while pollution is definitely a key concern and any developing economy, will have to face those kind of challenges. I think our government is already taking a lot of steps. I think there's a lot of focus on electric cars and, in that direction. But quite frankly, these are all longer term trends. I don't think, India can really afford to really switch to electric cars in a jiffy because, the costs of owning those kind of vehicles, I think we are still, at a nascent stage in terms of battery development and all those kind of things. So the cost of the vehicle is going to be very, very high. And it is not going to be accessible to everyone. So, while environmental issues are a big concern, the fact of the matter is we're still quite long away. So I think, with discretionary income, as KK just mentioned some time ago, that with discretionary income in India going up, some of these segments, some of these pockets, like automobiles, two-wheelers, etc., will see a lot of good growth over a period of time. The second question in terms of the global
geopolitical issue, shadow on the
so, I think, these kind of issues will keep coming up. I don't think, the world is going to be a very good place, especially after the financial crisis. It's become a very challenging place. Investing has not been a very easy thing. I mean, if it was easy, then I don't think, you guys would have taken so much trouble to come and listen to us. I think there's going to be a lot of volatility. It could be North Korea, it could be, the Chinese slowdown, Chinese economy slowing down. It could be US interest rates going up. Quite frankly, I think, the best thing for any investor. So, for example, let me just tell you quickly, what we do. So, 80% of our time typically goes in analyzing companies, the stocks that we own, because that's much more, predictable. That's much more something not in our control, but certainly something where we have some skills or, some core competence in terms of analyzing. Analyzing commodities, analyzing, which way the bomb is going to fly.
Global macros,
yeah, global macros. We give very little importance to because, as long as India is on a growth path, as long as some of the companies that we own are doing well, I think, that's the time well spent.
Okay. One last question here. Gentleman, the green shirt, yeah.
Government
का
may
सवाल क्या है?
implement long-term capital gain tax on equity.
Okay.
Is it possible? And if it is implemented, what will be the effect on the market? And as an investor, what should we do?
Should he be concerned about this or not?
Sir, I think there is definitely a case that's being built to tax long-term capital gains at some reasonable rate. Already the tenure of capital gains has moved to 3 years for debt instruments. So I think there will be some normalization in terms of the holding period, and a certain tax for capital gains within the 3-year period could be announced in the budget, because the government needs some amount of boosted revenues also. And I think there's a fair bit of thought that anything where there's profit, there should be some kind of tax that one should pay, which the government circles feel that is very fair for that to happen. But from an impact perspective, I think these are things which will blow over a day or two or a week's time. We have seen a lot more stronger initiatives taken by the government in terms of FA taxation, know your client, GAR, etc. All these things have blown over a period of time, and so I think the markets are far more matured, and any correction that probably comes from that would be a good opportunity to add to our portfolio. I think, it's something that one has to take in terms of take it in a stride.
Okay, you want to add to that?
Yeah, I would like to add. Actually, one of my budget wish list includes this point that increase the we increase the period for availing the benefit of long-term capital gain from 1 year to 3 years. See, actually, markets will definitely react negatively on this, but it is very healthy for investors. 1 year is too less for an equity investor to analyze returns. And what happens is, if the performance is bad, he moves out. If the performance is good, he adds upon, right? So actually, it should be increased to 3 years for us to stay invested for long term.
Good. One last question.
Sir.
Sir, उनके पीछे वाला अपने पीछे पूछने दीजिए. हाँ, the gentleman in the green shirt. Yeah, please stand up. Okay. Achha, in the meanwhile, you can continue with your second question.
Yeah, actually my question is on earnings growth and economic growth. In the last 2-3 years, the commodity prices were continuously falling. Interest rates were coming down. Indian macros were stable. Oil prices has come down from $120 to $30. Still, India was slowing down. Indian economy was slowing down. There was negligible, if any, earnings growth. Now the picture has actually reversed. Commodity prices are moving up. Crude has also started moving up. It is very difficult to predict whether the crude will again come down to $60 as you suggested, or it moves up to $100. Macros are deteriorating. After the introduction of the GST, the tax collections have been coming down continuously, and the fiscal deficit is likely to balloon quite largely. So what makes you think that economic growth will pick up and consequently the earnings will come in?
I'll just preempt your, for the next part, which you didn't ask, what will happen to markets, right? So that's the worry. See, as you said, all the risks that you outlined at this point in time are something which is well known, right? I mean, when you talk about it, I think, all of us, market participants, etc., are aware of those risks. Generally, markets, have discounted a lot of these things which are known risks. Markets fall or capitalize or capitulate when there is an unknown element of risk that creeps in, basically. So I think, so to the extent I think most of the factors, uncertainty talked about are well known and well discounted in terms of market prices. But just to take your points forward, I think fiscal, I think because of DST disruptions, etc., there's been a small slippage. Bond markets already reacted to that, and equity markets also did, correct, and we did see that that into the next fiscal with better growth, etc., the fiscal could be taken care of in terms of where it needs to be. And the most important factor here is that a slippage of 30 bips in terms of fiscal deficit is not something as worrisome as growth being below 6% for long, right? So any kind of fiscal adjustment that the government does to encourage growth will be far more welcome at this point in time, rather than a slippage of 20-30 bips and yield movement of 20-30 basis points. So I think that's the way one should look at it. Secondly, in terms of crude price, etc., I think it's well-known fact that US produces and has a lot of reserves of shale oil and shale gas, right? I think at every incremental improvement in crude price above 60, the viability of shale oil becomes very, very high. And that's something that Saudi or OPEC will not want, actually, right? Though they want a good price for their own benefit, at the same time they don't want to disturb the overall equilibrium by getting the US to produce more and bring oil to the market, which will crash the prices further. So I think there's a certain equilibrium that everybody is aware of. And so broadly, the global growth is perfectly balanced across various countries and various commodity players and commodity users in that sense. So I think that's a sweet spot that we are in, and I think we have used the last few years to improve our macros, and I seriously doubt that the macros are deteriorating at this point in time. you please tell me, when have you seen this kind of currency stability that India had in the last 2 to 3 years? I think it's been a perfect, condition, and where the capital flows have been so good to support, any deficit on the current account. I think India or any country should not just be, leveraging just currency for exports. There should be inherent competitiveness in terms of factor cost of production. That is what this government has been trying to do. Bring the logistics cost down, bring the power cost down, bring the labor cost within control, right? And improve productivity by skill development, etc. So that's what is more important, and that we have achieved a lot compared to Chinese, which are a competition on many products, whereas Chinese per capita, cost of producing a particular product has gone up. I think Indian costs have come down. That is why India, to whatever extent India exports have been doing, I think that's because of better competitive positioning, and we believe that a lot of inroads have been made, and with global growth coming back, exports will definitely start to look up as we go along.
All right, gentlemen, on that note, we'll wind up this session. I would like to thank Mehta FinCon and the entire family for arranging such a vibrant session. And of course, RS Team's panelists for sharing their knowledgeable inputs on this in this conversation today. Thank you all. Thank you very much.